Do you know what lending arbitrage is? Well, you may not even realize this, but you're probably participating in it right now. It's the way that a lot of people and companies make a lot of money. And today, in this video, I'm going to go into detail about what lending arbitrage is and how you can participate and benefit from it. My name is Shiloh Lundahl, and you are watching the Improved channel focused on real estate investing. So what is lending arbitrage and how am I participating in it if I don't even know what it is? Well, let me explain it in very, very simple terms. Lending arbitrage is the ability to borrow money at one interest rate and then lend it out at a higher interest rate. The arbitrage is the difference between what you borrow it at and what you lend it at, and that's the profit to you.
But wait, I don't do lending arbitrage. Why would you say I participate in it?
This happens every time you take your money to the bank. You see, when you give your money to the bank says, thank you, I'll go ahead and I'll deposit your money into your account. And then what do? They go and they lend out your money to somebody else and they charge that person an interest rate. Now they pay you an interest rate, kind of. Have you seen your interest rates lately from the bank? Horrible, right? Let's say your bank gives you, what is it?
0.01%.
And then they take your money and they lend it out to somebody else who wants to either buy a car or a home or wants to get a business loan. And then they charge that person maybe 4, 5, or 6% on your money. You see, they're charging 6% and then they only pay you like 0.1%. And they get to keep the difference.
But wait, Shiloh, I'm not a bank, so how can I participate in something like this?
That is a great question. You see, a lot of us aren't even aware of our ability to borrow money. Sure, we borrowed money to buy a house or to buy a car, but a lot of us aren't aware that if we have access to money, that we can take that money and with a little bit of skill and understanding and experience, we can take that money and we can create more money with that money. You got to be careful because some people do this very poorly and they lose that money, yet they're still on the hook to pay back that loan. So you don't want to do it unwisely, and I'll go into detail about how to do it more wisely as we go on in this video. But I just want to get down the concept first. The idea is this. If I'm able to borrow money at a certain rate, and if I know how to, because of experience, because of knowledge, I can take that money and I can put it somewhere where it will earn more money. What happens is I'm able to then keep that difference. That difference is then my profit. Let me give you a very real example. Let's say I have a home that has a mortgage on it. And let's say I got that mortgage 5, 6, 7 years ago. And like me and many other people, my home has increased in value. So I go to the bank and I say, well, Mr. Bank, I have this home and according to Zillow, it says it's worth $500,000. And I got a loan with you when that house was only worth about $300,000. And I've been paying it pretty diligently over the last 5 or 6 years. So now I may only owe maybe $250,000 depending on my interest rate and term of the loan. And let's say that I have $250,000 worth of what's called equity. That means that if I were to sell this home today, not including sales costs or realtor fees or anything like that, let's just say I were to sell the house and without any of those fees, I would be able to pay off the mortgage and then I would be able to keep the $250,000 of equity that I have in the house. But let's say that I don't want to sell the house. I just want to figure out a way to access some of that equity. So there is a loan that you can get called a home equity line of credit, sometimes referred to as a HELOC or an equity line of credit. What I can do is if the bank takes a look at me and recognizes I have good credit, and I have the ability to repay the loan, they may very well create a line of credit on my home. So now, rather than just owing $250,000, they may say, well, you know what? You're a good borrower. I think that I can lend you more money because I think that you're going to pay it back, because that's what your history tells me. And I take a look at your finances and I can see you earn enough money to pay me back. So I'm going to go ahead and create this line of credit for you. So now let's say, rather than just owing $250,000, he gives me another $100,000 line of credit on my home.
So now what do I do with this $100,000?
It's a really good question. I can go on vacation and take that money and just live it up and have a fantastic time. What do you say? Sound good? I think it sounds good. No. What I think is even better than that is thinking, what can I do with this money in order to create more money? Let's say the bank lends it to me at 4%. Okay, so I have access to $100,000 at 4%. What that basically means is, if I were to take out all $100,000 in that equity line of credit, I would need to pay the bank back $4,000 of interest over that year period of time. But rather than go and just blow that money on either a vacation or going to Vegas and taking my chances, rather than that, let's say that I am now a real estate investor, or I'm learning how to be a real estate investor. And I decide, you know what? I want to go and buy a rental property. So maybe I've been working with a real estate agent, or I've been part of an investor group learning how to invest in real estate. And let's say I find a property and it's a really good property. And I look at it and I think, okay, this property costs $80,000. So maybe it's in the Midwest, maybe North Carolina, South Carolina. And I'm looking at it, I'm like, you know what? This is a cute little property. It's a nice red brick home that was built in the 80s. Needs a little bit of updating, but if I update it, I think it's going to probably bring in maybe $1,100 or $1,200 of rent every month. So let's say I take my $100,000, I buy that property for $80,000, and then I take $10,000 more and I rehab that property, or just go in and do some fixes and updates and things like that. Now that property may be worth $110,000 or $120,000. So I may have just created $20,000 or $30,000 if I'm able to find a pretty good deal, a deal that looks like it needs to be updated. There's some things wrong with it, but I can go in there and I can get those things fixed up by either doing it myself or hiring a crew to go in there and take care of it. So let's say I have the know-how to do that. So I borrow $100,000 out of my home equity line of credit, and I can take that and I can use that if I have the skills and abilities. Remember that, that's really important. So I have the education, I've been working with people, I've learned how to do this, because if you don't know how to do this, you may very well buy a property that's going to cost a lot more than it's worth. So you don't want to do that. You need to have the skills in order to do this correctly. But let's say I go and I do it. I find a good deal, I buy the property, and then after I get the property and I rehab the property, I can go and I can get a loan on this property. And so as I get a loan on the property, the new bank is willing to lend to me, let's say maybe $70,000 on this one property. Now remember, I bought it for $80,000 and I put $10,000 into it. And so I still have about $20,000 left in this property. But I can take that $70,000 that the bank gave to me and I can go and I can put that back into my home equity line of credit, so I don't have to pay interest on that money while I'm not using it. That's one of the reasons that I really like home equity lines of credit, is because I only pay interest when I'm actually using the money. Now I put back that $70,000 and I didn't use that other $10,000 at the beginning. So I only ended up using about $20,000 of my full $100,000 in my equity line of credit. And now with this new loan on this new property, plus taxes and insurance and saving some money for maintenance and repairs and things like that, let's say with this property, I'm making about $300 a month in cash flow on this new property. How does that sound? Fantastic. But wait, remember, I used $20,000 of my home equity line of credit. and I still need to pay interest on that $20,000 every month. So remember, if my interest is 4%, then I need to pay 4% of $20,000. That comes to $800 a year in interest. Now we take that $800 and we divide it by 12. So ultimately, that's about $67 a month of interest. So you remember that I'm getting $300 a month in cash flow, and I need to pay $67 a month towards the HELOC, which lent me the money in order to buy the property. So you take that $300 and you minus $67, and I'm making $233. You see, that's how arbitrage works. I borrow at 4% here, and I put it into an investment that then creates a good return, and then I'm paying back my original loan, and as I do that, I get to keep the difference. And that is how lending arbitrage works.
But wait, what if I don't have enough time to go out and find a property myself? What do I do then? How do I participate in lending arbitrage when I don't have the experience, I don't have the know-how, and I don't have the time to go out and find my own property? Is there something that I can do?
Absolutely. One of the ways to participate in lending arbitrage, if you don't have the time to go and find your own deals, is find somebody who knows how to find deals. And then what you do is you access money at a lower interest rate, and you take that money and you can lend it to them at a higher interest rate. Let me give you an example. Over the last 4 or 5 years, I've really dedicated myself to learning how to invest in real estate. And we've done probably 250 to 270 transactions over the last 5 years. That means either buying real estate, selling real estate, or buying and holding those properties. So we have done a lot of deals over the last 5 years. How in the world would I be able to buy so many properties without being like a gazillionaire? Well, the way that I do it is I often don't use my own money to buy real estate. I will often use either money from hard money lenders or private money lenders or from banks. Those are the main sources that I use in order to acquire properties. And over the last few years, I've been able to raise millions of dollars in private money loans in order to help me rehab properties, and then I'll get a bank loan in order to pay off the hard money lender and the private money lender. And then I'm able to acquire another property. And because I'm able to find properties well under market value, I am usually able to acquire the property without having a lot of my own money left into the deal once we've paid off the hard money lender and the private money lender. Sometimes I'll have $5,000 or $10,000 left into the deal, but oftentimes I can actually get cash coming back to me after I've acquired a deal and paid off both the hard money lender and the private money lender. It all has to do with how good you are at finding properties under market value.
So Shiloh, what are you saying? I can borrow money in maybe a home equity line of credit or some other credit instrument, and then I can go lend it out and earn more money than what I'm paying the bank?
Yes, that is a great way for the average person that doesn't have a lot of time to go and find their own deals. It's a great way for them to be able to earn money on their money, or to be able to earn money and leverage their credit in order to access money from the bank and be able to take that money and make more money on it. So like I've said, I've raised millions of dollars in private money loans. So now we're doing something a little bit different than what we used to do. Before, we used to have a private money lender come in and lend on just one property, and then when we would refinance it, that money would go back to the lender. But we've had people lend to us multiple times, and they want their money just to stay at work and keep multiplying. So rather than just having private money lenders invest in one property, what we've done recently is we've created a fund. So now, rather than just investing in one property, our private money lenders now are investors, and they invest into the fund, and then the fund creates loans to our different companies that go and buy real estate and then pay interest back to the fund, and then that interest then goes back to the investor. So this is a very passive and easy way of participating in lending arbitrage. When you're able to take some of your own money or you're able to borrow some money from the bank at a low interest rate of maybe 4 or 5%, and then you can lend that out at either 8, 9, or 10%, what happens is you get to keep that difference. So for however much you're able to take out and then lend, you can oftentimes make a few hundred to even a few $1,000s a month on your money without you having to go and find your own deals. Now, I want to caution you about a couple of things that are important. When you lend out your money, it's very, very important that you get that money back. Wouldn't it be awful if I got a $100,000 home equity line of credit and I took that and I lent it to some guy who gave me big ideas and big dreams, and I'm like, okay, this is going to be great. And then after I lent it to him, guess what? The investment was awful and lost all of my money. Wouldn't that be awful? Because I still have to pay back the bank $100,000 extra over my $250,000 mortgage. That would just be horrible. So if you're going to lend your money out, there's a couple of things that are really important. What I would say is, first, know who you're lending money to. Have a relationship with them. Get to know them. Get to know their investing model. What do they invest in? What is their rate of success? Have other people lent to them before? And how has it gone for them? Another thing that's important to know is, do they have cash reserves in order to take care of problems if problems were to come up? I've lent my money out a couple of times, and I've learned through difficult experiences that if I lend my money to people that don't have enough in cash reserves, guess what usually happens? They use my money in order to deal with their problems. And then it's gone. You don't want to do that. So make sure you get to know who it is that you're lending to. Make sure that they have a good track record. And third, make sure that they have cash reserves. And then fourth, make sure that things are documented so that your expectations and their expectations are the same. One of the ways in which lending can ruin relationships is when things aren't explained clearly and expectations aren't the same. And that can oftentimes ruin relationships. And you don't want to do that. So make sure things are clear and make sure that the expectations are the same. Well, thanks for watching this video. I hope that the explanation of what lending arbitrage is was helpful to you. I really hope you got a lot out of it. And if you did, please like the video and comment below. I'd love to hear if you've had experiences with this and what it was like. And also, while you're commenting, you might as well subscribe if you haven't already. I really appreciate it. And I hope that you have a fantastic day investing in real estate.